Recently, in the National People's Congress, China said it will continue to enhance its policy of opening the market to foreign companies in the financial services industry, including the insurance sector. Joining us now is James Chan, senior financial analyst at AM Best, to talk about China's initiatives. James, could you tell us about the recent development of China's policy on foreign insurance investments?
Last year, China made a regulatory move to lift the cap on foreign ownership of insurance companies to 51%, and also to remove the cap within the next 3 years. Foreign insurers, they do not need to establish a representative office in China for 2 consecutive years before they could apply to establish a fully owned entity. And recently, the National People's Congress has approved the amendment of foreign investment regulations. And indeed, we have seen regulators grant approvals to several insurers and banks to enter China's market. As trade negotiations between China and the United States have made positive progress, we believe that China will continue to open up its financial sector to foreign capital.
Is capital from overseas markets a driver for China's initiatives to open up to foreign investments?
While there is abundant capacity in the international capital market, China's insurance sector continues to rely mainly on its onshore capital market. In recent years, we have seen an increase in offshore issuance of US dollar-denominated debts, as well as equity investments by foreign capital providers. While the capital volume raised still remains small compared to the financing raised on the mainland, there are several key factors driving this capital demand. For instance, the implementation of the C-ROSS solvency regime in 2016, the continued robust growth in premiums, as well as recent regulatory directives in promoting a more protection-type oriented life insurance markets. These are the factors that support the capital demand. In 2015, with the launch of capital supplementary bonds, we have seen the total volume of debt issuance peaked during that year, while in the following 2 years, we saw a sharp decline as the government tried to deleverage the economy, and there was also a slowdown in terms of the regulatory approval process. But nonetheless, in 2018, we have again seen financing activities picking up. Offshore debts are mainly issued by large-size life insurance companies as well as insurance groups. These companies stand to benefit from the enhanced international business profile, a lower cost of capital, a diversified source of capital, as well as higher financial flexibility in terms of the issuance structure. Going forward, as China continues to open up its insurance market to foreign investments, the sector would continue to benefit from an expanded capital source to support its ongoing growth.
James, what do you see as the most attractive areas for foreign insurers' investments in China?
Between the life and non-life insurance sectors in China, the latter is relatively more open to foreign investors. In 2018, there were together 66 domestic non-life insurers, while there were 22 foreign players, of which majority of them were fully owned by the overseas parents. On the other hand, on the life side, majority of the life insurance companies, they are joint ventures between domestic non-insurance enterprises with foreign insurance groups. But only a handful of them have foreign ownership of 51% or more. Despite the increasing affluence as well as the expanding middle-income class, China's protection gap remains quite wide. In our own opinion, we think that the China's life sector continues to pose a lot of opportunities for foreign capital. Indeed, foreign players have seen better success in penetrating China's life market For example, in 2018, they account for about 8.1% in terms of direct premiums written, while on the life side, the market share was only 1.9%. With the introduction of foreign capital into China's insurance market, we think the market stands to benefit from their transferable knowledge in terms of best practices, strategy, innovative ideas, as well as product design and pricing, in particular for protection type products. Going forward, we think the insurance sector would continue to also benefit from their underwriting know-how as well as financial flexibility, and more importantly, in terms of building a sustainable business model.
Thank you, James. For AM Best TV, I'm John Weber.